Hey, Smartypants! After 15 years, I just paid off my student loans this past week. And I've learned a lot in this time that I want to share with you. Today I am sharing the best way to pay off student loans. 5 expert tips everyone can use to maximize your payments and use your money most efficiently when paying off student loans so that you can save money and pay them off faster. Now, if you're going to apply for a program like public service loan forgiveness, don't pay $1 extra on your student loans. That doesn't make any sense. First, and very importantly, don't focus your extra money that you have on paying off student loan debt if you have high interest debts. If you're carrying credit card debt or any debt with interest above what you're paying on your student loan, pay that off first. I know you probably owe more on your student loans than anything else, so they just feel like this elephant on your back. But lower interest debts are much more efficient with your money. They're like a 50 mile per gallon hybrid, whereas higher interest debts, credit card debts, those are your 12 mile an hour gas guzzlers. Just like you'll save way more money on gas by driving a hybrid, you'll save more money on your debts if you pay off the high interest rate debts first. Think about it this way. 10 grand in credit card debt can accrue the same amount of interest as 30 grand of student loan debt in 1 year. So the more efficient way to use your extra money is to pay off the credit card debt, because you can pay off 10 grand worth of debt way faster than you can pay off 30 grand worth of debt. Number 2, choose the right payment plan. The great thing about federal student loans is they give you a lot of options on how you can pay them back. It's a buffet of payment options. I'm not going to define all of them for you. That's another video. Let me know in the comments if you want me to do that video. The most efficient one, and the one with the highest monthly payment, is the standard repayment plan. That one's the most efficient because you pay the least amount in interest over those 10 years. Then you've got a payment plan like the graduated repayment, which is also 10 years, but you pay a smaller amount at the beginning and then more and more and more and more and more as the time goes on. That could be an awesome plan if you have credit card debt, so you can use that extra money that you aren't paying towards your student loans, get rid of those credit card debts first. Then they've got the extended repayment plan, which is 25 years. They've got revised pay as you earn, where your payments are always 10% of your income, and whatever is left after 20 or 25 years is forgiven. There is pay as you earn, income-based, income contingent. You see where I'm going. You have a lot of options, so take them. You can find out what would be best for you at the Federal Loan Simulator. I put a link in the description. Number 3, many lenders will take 0.25% off your student loan interest rate if you sign up for Autodebit. This little bit could save you hundreds, if not thousands of dollars on your student loans over the course of years. What this means is they will automatically take the money from your account and pay off your student loans every single month. If your student loan interest rate is 6.5%, and when you put on Autodebit, it'll now be 6.25%. And there's a bonus. Because they're taking it out on time every single month, this will increase your credit score. So when you go to get a loan for a car or a house or anything like that, you'll save a lot more money on that loan because your credit score will be higher. Now, only do this one if you won't overdraft. If you're afraid you could overdraft, maybe don't do the auto debit. Number 4, pay down your student loans the smart way. You see, every time you send in a payment, the money first goes to interest and then it goes to principal. Your goal is to knock the principal down, which can only be done after interest has been taken care of. The best way to do this is to send in a lump sum with your regular payment. What worked really well for me was to double a payment once a year. This took 5 years off my loans and saved me thousands of dollars. For example, if your payment is $500 a month, then once a year you pay $1,000 instead of $500. Now, if your ability to double your payment once a year is as likely to happen as your chance of becoming the Queen of England, instead of doubling your payment once a year, you are going to pay half the monthly bill every 2 weeks. In this situation, that would be $250 every 2 weeks. It's not going to feel all that different from sending in your $500 a month, but in both cases, you'll end up with paying 13 total payments in 12 months. The sooner you do this, the bigger an effect it'll have on your student loans. If you're able to double the payment more than once a year, cool, do it. Remember, the way the math works, it's better to put in a lump sum once than to slowly chip away, but both are better than following the regular plan. My name is Kate Moody, creator of the Saving Spree Budget, here to help you outsmart your money. I'm driven by the idea that good people can do great things when they get control of their money. So if you're ready to take control of your money, be sure to subscribe. Now, lastly, and with a grain of salt, you can look into refinancing if you have a steady income and can assume you'll have a reliable income for the duration of the repayment, so you won't need the versatility of the federal payments I talked about earlier. If you absolutely won't be applying for public service loan forgiveness or teacher loan forgiveness or any of those kinds of programs. And if you have a great credit score, only then it might be a good idea to refinance your loans through another servicer. Basically, somebody will buy your debt from the federal government, and now you owe the new company, but like maybe you were paying 6.5% to the federal government, the new company might only charge you 3%. That is a huge drop in your interest rate. Lots of savings for you. Now remember, doing this means you can't get on an income-based repayment plan or defer if you go back to school or get public service loan forgiveness. If you lose your job, you'll still have to pay, unlike with federal loans. So big grain of salt. Make sure that you hit all those ifs that I talked about. You are going to 1. Pay off high interest rate debt first. 2. Get on the right payment plan. 3. Sign up for Autodebit. 4. Pay double once a year or half your monthly payment every 2 weeks. And 5. Maybe look into refinancing. Thanks for watching. Cheers.